Hi, it's Larry Gaines, PowerCycleTrading.com. Well, in this video, I want to show you a really cool trading strategy. This is called the diagonal spread, or sometimes referred to as the calendar diagonal. But basically, the diagonal spread is a strategy that shares a lot of the same characteristics as the calendar income spread. So what it does, it takes advantage of accelerated time decay characteristics that near month option has for the calendar spread, so it decays faster than the back month. But what it does is it adds an additional vertical spread component to add that potential profit point for a directional move up or down. So basically what happens is you're setting up a structure where you can actually buy options at a discount. So let's take a look at a trade setup here to show you how this kind of buying options at a discount can work. So here's Apple. It had a nice kind of bottoming pattern here, and then right here on the 30th and the 31st, it started to break above this 50% retracement level on Fibonacci. So right in here, the structure was looking like, it's trading right around 165 and had a potential target up to 170, 175. But, with the potential for this trade to actually maybe pull back, retest these levels, and then at some point in time build for a push higher. So in this strategy, what you're doing is you can kind of buy time while it kind of churns. If it comes up here, pulls back, which it did, buy time, and then reduce the cost of your back month long option by the front month time decay. So here's what that looks like. So this diagonal is set up on the 31st, and so what it was buying the March 15 series, the 165 call, and then selling the front end or the closer end series, the 15 February series at the 170 strike. So bought the 165 at 645 debit, and then sold the 170 call strike at for the 15 Feb at $1.88. Now on Friday, you can see that went out at 26 cents. So this was closed out at like 40 cents. And so the credit spread side of the trade, by the 188 short, buying it back at 40, closed this part of the trade out with a $1.48 profit on the credit spread side, which then you could use to adjust down the debit spread of 645, reducing that cost down by the $1.48 profit to 497. So you just adjusted that trade down, and now this is what it looks like. So the original March 15 series 165 call was originally at 645. You adjusted that down by the profit received from the credit spread. So that drops the cost of that 165 call to 497. So now coming into today's date, the 17th, the market has this up $262. Now you have the flexibility to also then add an additional credit spread. So you could come out and I could sell the 175 March against it, bring 91 cents, or could sell the 22 Feb series, bring in for the 170, bring in $1.90, or sell the February 22 series, bring in the 172.5. So a lot of different variations here to convert this back to a long call diagonal spread and try to gain more credit out of it, adjusting this even down lower. So basically you're amortizing down the cost of your long call by bringing in premium, and as long as that's decaying, that's adding additional income into your portfolio or adjusting your long call debit spread or long call side of this spread down lower and lower. All right, hope this helps, and if you'd like to learn more about this, join us tomorrow night for a free video, not a free video, but a free webinar on this strategy and calendar spreads, which will be at 6 p.m. Eastern.